Hello, in this third part of the Blue Sky Toys case study video, I want to talk you through the effect that transactions have on the three financial documents. So just to remind you what we've got the cash flow document here with the closing balance line across here and noting the two negatives. And the profit and loss is just down here. It's a very simple profit and loss. And the balance sheet is over here. And I've got my little check here, as I showed you in the previous video, that tests whether the net assets from the source of funds, which, because this is the first financial reporting period, is equal to the retained profits, so 3,925, that's over here. And then this is the application of the funds. So it's the fixed assets plus the current assets minus current liabilities minus long-term liabilities. If those two numbers match, I get a yes in here. If they don't match, I get a no. That's quite important for this video because I am temporarily going to throw it out of balance occasionally, and we need to see what's going on. So I'm going to add things in little bit by little bit for a couple of examples. So if you don't know how to get to this spreadsheet, go to look to the first video. If you want to know how to deal with the minus 145 and the minus 80, go to the second video. So onwards. What I'm going to look at first of all is just a single additional purchase that the company is going to make, and we're going to make this purchase in May, and we're going to, what's in effect, revenue it. So we're going to charge it to the profit and loss. So it doesn't create a fixed asset, it creates something that gets used within the business during the trading cycle. So it could be a bulk lot of stationery that they're using up, or it could be a meal out for the staff as a thank you for all the hard work to start with. Okay, so I'm going to put it in miscellaneous expenses because it doesn't matter where it goes, but we'll put it in there. So at the moment it's £10, and I'm going to increase it to 510. Now, I want to see what the effect of that is on these three financial documents. Let's just think about this for a second. It's an additional expense, so we're paying out £500, so you'd expect the cash to drop by £500. Now, it doesn't create any stock, it doesn't create a debtor, it doesn't create a liability, and it doesn't create any long-term liabilities. All it does is it reduces the profit by £500. So what I would expect to see is that the closing balance here drops by 500, so this one will also drop by 500. The overheads, because it's charged to overheads, will go up by 500, so the profit will go down by 500. That means the retained profit goes down by 500, but the cash also goes down 500, so these two should both go down by 500. Okay, if you don't get that, replay this video. So I'm going to hit the return to set that value, and what's happened? The closing cash balance has gone down by 500, the overheads have gone up by 500, the net profit's gone down by 500, which is the same as here. The cash has gone down by 500, so the net assets, the application of funds, has gone down by 500. So these two are still in balance, so we still keep a yes. So it's done exactly what we expected it to. Brilliant. Okay, let's put that back to 10 and try something else. This time I'm going to spend £1,000 in June, and I'm going to buy a car. Okay, so this time it's going to create a fixed asset, and it creates the fixed asset in the last month of the trading period. So we don't have to worry about anything like depreciation. We'll cover depreciation later on. So I'm going to create a new line underneath here, and it's called vehicle. If I can spell it right, vehicle purchase. and I'm going to put £1,000 in here. Now at the moment that doesn't do anything because that cell isn't linked in here. So what does happen? What should happen? Okay, so the cash should drop by 1,000. It's charged to fixed assets, so fixed assets, we're creating a fixed asset. In effect, we're swapping £1,000 worth of cash for £1,000 worth of fixed assets. So if we do this right, the fixed assets should go up by 1,000, the cash should go down by 1,000, which means our total assets here, and hence our net assets, won't change. So the fixed assets equals the price of that, and because I've only put one entry in, we're now out of balance. What I haven't done is to take reduce the cash by that. So we need to take away that cash amount. So the cash has now dropped to £80, and we see these. That's corrected that problem. So our net assets now are a fixed asset go up by 1,000, and our cash has gone down by 1,000. Okay. So in both those two cases, we have two actions that are taking place somewhere within the three documents. One balances the other one out to keep the overall balance sheet in balance. So this is kind of the basis of double entry bookkeeping. Now we're not actually going to do double entry bookkeeping, but the principle is every financial transaction has a double action, double consequence. Okay, so I just want to take these out again, and we should be back to where we were. Yep, we are back to where we were. Okay, the third thing I want to show you is creating something or other that has an effect after the end of the financial period we're reporting on. So in this case, I'm going to purchase in May an insurance policy for 12 months that starts being used in June. Okay, so I now need to create two rows in here, so I'm going to insert two rows. Okay, and the first one is going to be insurance policy purchase, and the second line is insurance policy use. Okay, I just want to make sure when I put the values in, we'll see what happens. And it's a fairly cheap insurance, so I'm going to pay it. I'll tell you what, we'll purchase it in April, and we'll purchase it for £60. Okay, and good, that's made no changes because we're not using that cell. Now it's a policy for 12 months worth of insurance cover, and 12 into 60 of course goes 5. We start using it in May and June, so we're using £5 and £5 in May and June, and we have the remainder left for the following year. We'll deal with that in a minute. So the cash out needs to increase the cash out by 60 because we're spending an extra 60. So it's plus that cell there. Okay. Now we've got thrown out of balance because we've not really dealt with what's going on here completely yet. We're using 2 lots of £5 which we charge against sales. It's an overhead. So our overheads over here, which is the sum of those, needs to add in the sum of the insurance policy payments, the insurance we're using in the financial period we're reporting. Okay. So 460, that goes up to 460. We're still wrong. We're still not in balance. Why are we still out of balance here? Because we have bought 12 months worth of insurance, but we've actually only used 2 months worth. we have 10 months left. So we have purchased in this financial period 10 months worth of insurance that we've not yet used. So that is an asset. Okay? And the term for that is a prepayment. We have prepaid 10 months worth of insurance in this financial period. And prepayment is the fourth type of current asset. So let's take a look up here. The three types of cash, debtors and stock. We actually can add in prepayments now. So I'm just going to add a line in here by dragging those down one. I'm going to put prepayments in there, and the prepayment amount is the 60 minus the 10 we've used up here, so it's 50. So I'm going to put £50 in there, and because my total assets was the sum of those, it's already picked up the fact that I've added a new one in, and it's added it in, and what we see nicely is that that has now corrected the error, and we're now right. So in this case, the insurance policy has created in effect two pairs of transactions. And the first one is the cost of £10, which is a cash payment in exchange for two £5 or £10 total that gets charged to the profit and loss in the first trading period. And the second part of and those two balance. And the second part is the remaining 50, which is a reduction in cash of 50 in exchange for an increase in prepayments of 50. So that's the other pair here that in double entry bookkeeping terms, they balance out. So those four kind of transactions here, all, when we take them all into account, keep everything in balance. Okay, that's it for those are the three things I wanted to show you for as additional items that we put into this case. And that's it. Okay, thank you very much.